Welcome everyone. Thank you for joining ChemAnalyst third webinar session. Today's session will focus on the fertilizer market. We'll explore the impact of Middle East disruption on fertilizer supply, key market most affected by supply constraint and trade shift, and the near-term outlook for the global fertilizer market. A better understanding of the evolving market dynamics will obviously support you for better decision making. This webinar will be led by Saloni Kumari, research analyst, who will be sharing a detailed market analysis. Before I hand it over to her, I would like to mention if you missed our previous webinar on feedstock supply chain, the recording is available on ChemAnalyst LinkedIn page and YouTube channel. With that, over to you, Saloni.
Thank you for the introduction, Purnima. Hello, everyone, and a warm welcome to all of you joining us today. Let me begin this session with a thought. What if a narrow waterway located far from us could directly influence the price of food globally? This is exactly the situation we are witnessing today. A regional conflict in the Middle East has evolved into a global supply chain disruption, impacting fertilizers, agriculture, and ultimately food inflation. In today's session, I will walk you through the current situation, the key market reactions, and what this means for the near-term outlook. To understand the real impact of this situation, let's first look at how the market is behaving right now. The market is currently operating in a high volatility environment driven primarily by a sustained geopolitical risk premium. We are witnessing a clear shift from fundamental pricing to risk-driven pricing, where uncertainty itself is influencing market behavior. From a structural standpoint, the Middle East plays a critical role in global supply. It contributes nearly 40% of global urea exports and remains a key supplier of ammonia and sulfur. This creates a high level of global dependency on a single region. At the same time, a major logistical vulnerability exists through the Strait of Hormuz. Nearly one-third of global fertilizer trade passes through this route, making it a critical choke point for global supply flows. Now, adding to this volatility, there have been some very recent developments in the last 48 hours that are further intensifying market risk. Israeli airstrikes targeted Iran's South Pars gas field, halting over 12 million cubic meters per day of gas production. In response, Iran has launched retaliatory strikes on energy infrastructure in Qatar and Saudi Arabia, including key processing hubs. At the same time, China has tightened fertilizer exports, restricting urea shipments to prioritize domestic demand. Now, what does this mean for the market? We are now moving from anticipated risk to actual disruptions, where feedstock availability is tightening, export supply is being restricted, and global prices are reacting sharply. Moving forward, to understand the severity of the current situation, we need to look at the structural importance of the Middle East in the global fertilizer market. First, high concentration risk. The region accounts for significant fertilizer exports, be it urea, sulfur, or nitrogen. Second, the feedstock advantage. Fertilizer production, especially ammonia, depends a lot on the natural gas availability, which contributes about 70 to 80% of fertilizer production. Producers in the Middle East benefit from gas prices that are often 30 to 50% lower than regions like Europe. This creates a strong cost advantage. Third is strategic logistic dependency. A key factor that amplifies this risk is the region's dependence on the Strait of Hormuz, which handles a significant share of global energy flows, directly linking energy and fertilizer market. This makes it a single point of failure, where even minor disruption can delay shipments, increase freight cost by 15 to 25%, and create immediate supply uncertainty. So what does this mean to us? Even a 5 to 10% disruption in exports from this region or any blockage at the Strait of Hormuz can significantly tighten global supply and push prices upwards. That's why we can say that this crisis is not a localized issue, it is a systemic risk with global implications across pricing, supply chains, and food security. Now, as we discuss systemic risk, now let's just talk about the supply chain vulnerability. The current crisis is unfolding as a classic domino effect across the global supply chain. Let's break this down step by step. It begins with the geopolitical disruption in the Middle East, which immediately impacts trade flows. This leads to a logistical crisis, vessel rerouting increases transit times by 5 to 10 days, freight rates rises by 15 to 25%, war risk premium surge by 2 to 3 times. As logistics tighten, we move into supply reduction. Export flows slow down, availability declines in key importing regions. This creates a market reaction phase. Panic buying increases, price spikes rapidly, volatility intensifies. Eventually, the impact reaches the agricultural level. Farmers reduce fertilizer application by 5 to 15% due to higher costs. Crop yields are affected, and finally, this translates into food inflation, typically within 3 to 6 months, with potential price increases of up to 10 to 30% in extreme cases. The impact of the ongoing disruption is already clearly visible in the core nitrogen fertilizers such as ammonia and urea. Starting with ammonia, in China, prices have seen a sharp reversal from a decline of 1.72% to a strong increase of 7.53% within a short span. In the Middle East, prices have also moved upward by around 5 to 6%, reflecting tightening supply sentiments. Now, looking at urea in India, prices have increased by approximately 8% on a week-on-week basis. This marks a clear acceleration from earlier mild gains of around 1 to 2%, indicating a strong shift in market behavior. Now, the question is what's driving these prices? First factor would be panic buying and early procurement, with buyers securing cargo approximately 2 to 4 weeks ahead. Freight cost escalation of 15 to 25%, and most importantly, a risk premium being priced in even before actual shortages occur.
Okay, that's the great information you have shared so far, Saloni. Since you talk about ammonia and urea prices, I just wanted to understand which reason, according to you, is more exposed to urea price volatility right now?
So the import dependent markets will be the markets who are most affected for now, such as India and Southeast Asia and some parts of Africa, because these are heavily reliant on Middle Eastern supplies.
Okay, thank you.
Okay, so going forward, as we have already discussed the price volatility in urea and ammonia, I would further like to discuss the price volatility in DAP, which is diammonium phosphate and ammonium sulfate. Because the price is no longer limited to urea and ammonia, it has now spread across the broader fertilizer market. Starting with the DAP, in China, prices have increased from around 1.45% to 4.23% week on week, showing a clear acceleration. Major exporters like Saudi Arabia and Morocco have recorded even stronger gains of around 5 to 6%. Looking at ammonium sulfate, prices in China have surged nearly 7% week on week. In Europe, including markets like Germany, prices have increased by around 4%, indicating tightening regional supply. Again, the question is what's driving the broader price movement? For DAP and ammonium sulfate, substitution demand is there as buyers shift away from urea towards alternative nitrogen sources, tightening export availability, especially from key suppliers, and continued logistics and freight pressures. The impact of the current crisis is truly global, but the way it is playing out differs across regions. So I would like to break it down further. Starting with the Middle East, this region is the origin and logistic hub, and the impact here is immediate. Spot cargoes are carrying risk premiums, with producers holding back offers to assess the situation. Freight and insurance costs have surged due to war risk, especially around the Strait of Hormuz. This is also growing operational risk, including potential maintenance shutdowns. So supply tightening here is not just theoretical, it is already being priced into the market. Moving to China. China is acting as a production powerhouse, but with clear constraints. Strong domestic demand, especially for the spring season, is limiting export availability. Export volumes are being strategically controlled, and traders building long positions and holding back spot cargo. At the same time, higher freight rates to key destinations like India and Southeast Asia are reducing export competitiveness. So while China has capacity, its ability to stabilize global supply remains limited. If we talk about India, India is currently driving demand side pressure in the market. Tender activity, especially from agencies like RCF, is seeing aggressive offers. Procurement timing has become critical, with buyers trying to avoid peak volatility. The rising global prices are increasing the government subsidy burden, which may impact future tender decisions. At the same time, strong pre-monsoon stocking is leading to panic buying behavior. This is further tightening global availability and pushing prices upwards. In the United States and Europe, these are energy sensitive and import dependent markets. Fertilizer production costs are closely linked to natural gas prices, especially in Europe. The region is highly reliant on imports from the Middle East and North Africa. Ongoing disruptions are causing shipment delays and higher landed costs. If we talk about the US, the spring planting season is approaching, narrowing the window for supply correction. Given the current volatility, market participants are no longer reacting, they are actively adapting. Let's look at the key strategies being implemented across the value chain. First is product substitution. Buyers are increasingly shifting from urea to alternatives like ammonium sulfate and CAN. Wherever feasible, this is already visible with ammonium sulfate prices rising, indicating strong substitution demand. Second is procurement timing and planning. Instead of spot buying, companies are now securing volumes 2 to 4 weeks in advance and adopting staggered purchasing strategies. This helps reduce exposure to sudden price hikes within short periods. Third is supply diversification. There is a clear move to reduce dependency on Middle Eastern supply. Importers are increasingly sourcing from regions like China, Russia, and Egypt. However, as discussed earlier, this diversification can only partially offset the risk. Fourth is risk management. Market participants are increasingly using financial tools such as hedging, index linked contracts, and flexible volume agreements. This is critical in a market where freight costs have increased by 15 to 25% and price swings remain highly unpredictable. Fifth is logistics optimization. Companies are exploring alternative shipping routes, multi-port discharge strategies, and building inland inventory buffers. These steps are helping mitigate delays of 5 to 10 days caused by rerouting and congestion.
Okay. Okay, Saloni, you have discussed a lot about what should be done and what is there. One question that is there from every market participant is there any possibility that they can start importing their material from some other countries rather than relying on the Middle East? And is there any possibility you see in the coming future that Middle Eastern supply can be replaced by some other countries?
See, importing countries are actively diversifying their sourcing and they are looking for other options as well. For example, they are considering China, Russia, Egypt, Morocco, Indonesia, and even USA. But however, these suppliers cannot fully replace Middle Eastern supply. The region's scale cost advantage from low cost natural gas and export volumes make it irreplaceable in the short. Additionally, alternative suppliers face constraints such as export controls and geopolitical limitations. So, while diversification may help reduce risk, it can only partially offset the disruption, not completely replace.
Okay. Information.
Moving forward, let's now consolidate the key insights and their broader implications. First would be structural concentration risk. The current volatility highlights a deep structural dependency on the Middle East, and this level of concentration means that even a 5 to 10% disruption can create a disproportionate global impact. Second is food inflation pass-through. Historically, fertilizer price spikes translates into food inflation within a 3 to 6 months lag. With fertilizer prices already rising, we could see a 5 to 12% increase in food prices, particularly in import-dependent economies. Third is policy and trade intervention risk. In such scenarios, government tend to intervene. We are already seeing tighter export controls and domestic prioritization from countries like China, while subsidy pressures are rising in India. These policy shifts can further restrict global availability and amplify volatility. Fourth is working capital pressure. With freight rates increasing and product prices rising simultaneously, distributors and traders are facing significantly higher working capital requirements. This can lead to tighter credit availability across the supply chain. Fifth is shift towards efficiency and yield protection. Higher input costs are forcing farmers to optimize usage. We are seeing early signs of reduced applications, increased adoption of efficiency enhanced fertilizers, and great focus on precision agriculture. Now we will talk about the outlook, the future outlook for the fertilizer market, and what can be expected from the fertilizer market in the next few weeks. Looking ahead, the market is expected to evolve under three key scenarios over the next 8 to 12 weeks. First is base case scenario, which has 60% of probability, which means supply chains gradually adjust to disruption through rerouting and alternative sourcing. Prices remain elevated but stabilize within a range. The geopolitical risk premium becomes partially embedded in pricing. Second scenario would be the disruption scenario, which has almost 25% of probability. If tensions escalate, particularly around the Strait of Hormuz, we could see supply shocks, price spikes exceeding 20%, increased force majeure declarations, and this would create a severe short-term imbalance in global markets. Third scenario would be de-escalation scenario, which has a probability of almost 15% if geopolitical tensions ease quickly. Freight and insurance cost would decline, risk premium would most likely reduce, and prices may correct downwards by 10 to 20% from current highs. Now, what should we monitor closely? There are 5 key indicators which we need to look forward for. First one is freight rates, currently elevated with war risk premiums increasing sharply. But we could watch over freight rates fluctuations in the coming weeks and assess the market scenario. Second is Hormuz traffic. Volumes already down by around 10 to 12%, which is indicating early disruption signals. Third is natural gas prices, stable for now, but highly sensitive to geopolitical developments. Fourth is China's export policy, which remains tight, limiting global supply flexibility. Fifth would be India's tender activity, which is highly active with aggressive bidding influencing global price benchmarks. To conclude, fertilizers form the foundation of the global food supply chain. A disruption at this level does not remain isolated. It cascades into agriculture, food prices, and ultimately inflation. What we are witnessing today is a structural stress test of global supply chains driven by the intersection of geopolitics, energy, and trade. The key question is no longer whether the market will be impacted, but how long this disruption will persist and how deeply it will reshape global trade dynamics. Thank you for your time, everyone. And now I look forward to all of your questions. Thank you so much.
Okay. So, Saloni, before anybody asks, people have not asked any questions yet. So, I have a questions. Since we know when we talk about fertilizer market, it is directly linked to agriculture sector and then to the farmers. So, how do these development, the conflict of Middle East and then short material and these of how these development in fertilizer market impact the farmers and agriculture?
See, Purnima, rising fertilizer costs are expected to reduce fertilizer applications by about 5 to 15% in some regions. This can lead to lower crop yields and lower fertilizer application as well, which would eventually lead to lower production rates, further causing food inflation in the coming months. So now we can say that the fluctuations in the fertilizer market would eventually influence the farmers' decision on how much and which fertilizers they need to apply to their crops, which eventually would impact the crop yield and production, further causing food inflation.
Okay, thank you, Saloni. And now I would like to thank everyone who has joined this webinar. Following this webinar, you will be redirected to ChemAnalyst page where you can submit your questions and our team will directly reach out to you. So thank you, Saloni. Thank you for this insightful webinar and the discussion about fertilizer market and the impact and outlook that you see will happen in the market. Thank you.
You're most welcome, and thank you for your assistance as well.